Hello students, welcome to APG Pathshala. I am Dr. Sanjeev Sharma from Government College, Nadoon, Himachal Pradesh. Today we are going to talk on module International Financial Reporting Standards from paper Accounting and Financial Analysis. After studying this module, the students may able to understand the concept of global convergence of accounting standards, understand need and importance of convergence with International Financial Reporting Standards, explain convergence process of IFRS in India, explain the challenges to be faced for International Financial Reporting Standards implementation in India. Convergence of accounting standard is a step towards developing a globally accepted common language of accounting. Due to the process of globalization and increased cross-border investment are the important factors that generated the need for the development of and adoption of a single set of high quality universal accounting standards. In India, the process of convergence with IFRS is carried by Ministry of Corporate Affairs. The Institute of Chartered Accountants of India has formulated Indian accounting standards converged with IFRS, which are in line with corresponding international accounting standards or international financial reporting standards adoptable under the conditions prevailing in the country. Now, what is the global convergence of accounting standards? Convergence of accounting standard is a step towards developing a globally accepted common language of accounting to communicate financial information of an entity. Globally accepted financial reporting system ensure that financial transactions are recorded and presented in similar way all over the world. The Institute of Chartered Accountants of India and National Accounting Standards. The Institute of Chartered Accountants of India is premier accounting body in India with the purpose to bring uniformity in preparation and presentation of accounting results. The Institute of Chartered Accountants of India, constituted in 1977, an accounting standard board. The Institute of Chartered Accountants of India and National Accounting Standards. The main function of Accounting Standard Board is to formulate accounting standards. While formulating the accounting standards, the Accounting Standard Board gives due consideration to international accounting standards. It also keeps into consideration the applicable laws, customs, uses, and the business environments prevailing in India. The Institute of Chartered Accountants of India formulated 32 accounting standards, a list of which includes Accounting Standard 1, Disclosure of Accounting Policies, Accounting Standard 2, Valuation of Inventories, Accounting Standard 3, Cash Flow Statement, 4, Contingencies and Events occurring after the balance sheet date, 5, Net profit or loss for the prior period items and changes in accounting policies, 6, Depreciation accounting, 7, Construction contracts, 8, Accounting for research and development, 9, Revenue recognition, 10, Accounting for fixed assets, Accounting Standard 11, the effects of changes in foreign exchange rates, 12, Accounting for government grants, 13, Accounting for investments, 14, Accounting for amalgamation, 15, Employee benefits, 16, Borrowing costs, 17, Segment reporting, 18, Related party disclosures, 19, Leases, 20, Earning per share, 21, Consolidated financial statements. Accounting Standard 22, Accounting for taxes on income, 23. Accounting for investment in associates in consolidated financial statements. 24. Discontinuing operations. 25. Interim financial reporting. 26. Intangible assets. 27. Financial reporting of interest in joint venture. 28. Impairment of assets. 29. Provisions, contingent liabilities and contingent assets. 30. Financial instruments recognition and measurement. 31. Financial instruments preparation. 32. Financial instruments disclosures. International financial reporting standards. Now, what is the meaning of international financial reporting standards? I-4 international, F-4 financial, R-4 reporting and S-4 standards. It is disclosed by this figure. These are high quality, easily understandable, principle based, globally accepted and developed by IASB, International Accounting Standard Board. These are the accounting standards which are highly qualitative, easily understandable, based upon principles, accepted globally and developed by the International Accounting Standard Board. And these provide guidelines for disclosure and financial reportings. Convergence with IFRS. According to ICAI, convergence means to achieve harmony with international financial reporting standards. In precise terms, convergence can be considered to design and maintain national accounting standards in a way that financial statements prepared in accordance with national accounting standards draw unreserved statement of compliance with international financial reporting standards. What is the need for convergence with IFRS? It is an important question, and the answer of this question is provided by this figure. It is clear from this figure that due to globalization of the business, integration of capital markets, to clear the confusions, to bring the global acceptance of accounts, to remove the limitations of Indian generally accepted accounting principles, and to improve the transparency, need of convergence with international financial reporting standards arise. Now, it is important to understand what is the need of convergence with IFRS. Why convergence is needed in India? The first point is globalization of business. Due to the process of globalization, number of multinational companies are establishing their businesses in various countries. It has made imperative to have a single global accepted financial reporting system. Integration of capital markets. The entities are increasingly accessing the global markets to fulfill their capital needs by getting their securities listed on the stock exchanges outside their country. Thus, the global capital markets are becoming increasingly integrated. Indian companies are also being listed on overseas stock exchanges. So, there is an urgent need of sound financial reporting structure for effective functioning of capital markets. To clear the confusion, the use of different accounting frameworks in different countries creates confusion between users of financial statements. This confusion leads to inefficiency in capital markets across the world. Therefore, to clear the confusion and strengthen the trust, investors, a single set of high-quality global accounting standards is needed. Global acceptance. International financial reporting standards are globally accepted accounting frameworks. It is becoming a universal reporting system for financial statements. Presently, about 150 countries are already using international financial reporting standard in their countries. International financial reporting standards improve transparency in accounting system of an organization. Further, limitation of Indian generally accepted accounting principle can be removed with the help of international financial reporting standards. The difference between international financial reporting standard and Indian generally accepted accounting principle is shown in this table. Financial statement required. Under IFRS, financial statement include balance sheet, statement of comprehensive income, statement of cash flow, statement of changes in equity, notes and accounting policies. So there are 5 components which are included in financial statement. Whereas in case of Indian generally accepted accounting principles, financial statements include mainly balance sheet, profit and loss account and cash flow statement. Now next point is related with guidelines related to hedge accounting. Clear and specific guidelines related to hedge accounting are given in international financial reporting standards, and according to this, hedge account transactions should be classified as fair value hedge and cash flow hedge, whereas no such guidelines is available in Indian GAAP. Accounting of fixed assets. As far as accounting of fixed assets is concerned, it takes change in depreciation method as change in accounting estimates and apply these changes with prospective effect. International financial reporting standards take change in depreciation method as a change in accounting estimate and apply this change with prospective effect, whereas Indian GAAP takes change in depreciation method as change in accounting policy and apply these changes with retrospective effect. Further, presentation of extraordinary items. As far as presentation of extraordinary items is concerned, extraordinary items are presented in statement of comprehensive income or in notes according to international financial reporting standards, whereas according to Indian GAAP, extraordinary items are presented in the profit and loss statement of an entity. Convergence process of IFRS in India. In India, the process of convergence with international financial reporting standards is carried by Ministry of Corporate Affairs. And for this purpose, consultation and participation of all the concerned stakeholders is ensured by Ministry of Corporate Affairs. The Ministry of Corporate Affairs has taken initiative for harmonization of Indian accounting standards with international financial reporting standards. Proposed roadmap for international financial reporting standards implementation in India is shown with the help of this figure. Initial convergence roadmap, the timeline given in the initial roadmap is no longer valid. So, revised IFRS convergence roadmap was given by the government, and it is shown in this figure also that these are divided, roadmap are divided into 2 parts, initial and revised. According to initial roadmap for IFRS in India, the application of converged accounting standard in India was divided in three phases: first phase, second phase, and third phase. But the timeline given for this implementation has expired, and now a revised roadmap is given for IFRS implementation in India. Revised International Financial Reporting Standard Convergence Roadmap in India is given in this table, and it is clear from table that it is divided into two parts, one on voluntary basis and second on mandatory basis. On voluntary basis, for accounting period, it is applicable for accounting period beginning on or after 1st April 2015 with the comparatives for the periods ending on 31st March 2015 or thereafter. And for on mandatory basis, for accounting period beginning on or after 1st April 2016 with comparative for the periods ending on 31st March 2016 or thereafter, it is compulsory for all companies having net worth of 500 crore or more and holding subsidiary, joint venture, associate companies of these companies. All companies which having net worth of 500 crore or more plus holding subsidiary, joint venture, associate companies of these companies. These companies have to adopt IFRS on or after 1st April 2016. And for the accounting period beginning on or after 1st April 2017 with the comparatives for the period ending on 31st March 2017 or thereafter, companies whose equity or debt securities are listed or are in the process of being listed, or are in the process of being listed on any stock exchange in India or outside India, having a net worth of less than 500 crore, and companies other than those covered in paragraph 1 and paragraph 2 above, that is unlisted companies. Remaining companies are unlisted companies having a net worth of 200 crore or more and holding or subsidiary, joint venture or associate companies of the above class of companies. Now, what is the status of implementation of Indian accounting standards? The Institute of Chartered Accountants of India has formulated Indian accounting standards. Indian AS converges with IFRS, which are in line with corresponding international accounting standards or international financial reporting standards adoptable under the conditions prevailing in India. These are converged Indian accounting standards, Indian AS, hosted by Ministry of Corporate Affairs on its website. Converged Indian accounting standard, Indian AS, are shown in this table. Indian AS 101 is related with first time adoption of Indian accounting standard, 102 with share-based payment, 103 with business combinations, 104 with insurance contract, 105 non-current assets held for sale and discontinued operations, 106 exploration for and evaluation of mineral resources, 107 financial instruments disclosures, 108 operating segments, 109 financial instruments, 110 consolidated financial statements, 111 joint arrangements, 112 disclosure of interest in other entities, 113 fair value measurement, 114 regulatory deferral accounts, 112 revenue from contracts with customers, and 1 presentation of financial statements, 2 inventories, 7 statement of cash flows, 8 accounting policies, changes in accounting estimates and errors, 10 events after the reporting period, 12 income tax, 16 property, plant and equipment, 17 leases, 19 employee benefit, 20 accounting for government grants and disclosure of government assistance, 21 effects of changes in foreign exchange, 23 foreign cost accounting, Indian accounting standard, 24 related party disclosures, 27 separate financial statements, 28 investment in associates and joint venture, 29 financial reporting in hyperinflationary economies, 32 financial instruments presentation, 33 earning per share, 34 interim financial reporting, 36 impairment of assets, 37 provisions, contingent liabilities, contingent assets, 38 intangible assets, 40 investment property, and 41 agriculture. The benefits of International Financial Reporting Standard is shown in this figure. International Financial Reporting Standards provides benefit to economy, to investors, to industry, and to accounting professionals. It shows that it is very beneficial to adopt the International Financial Reporting Standards, as it is going to serve different sectors of the nations. For example, it is going to benefit the economy, it is going to benefit the investors, industry, and accounting professionals. Benefits of IFRS in India. The benefits which are provided by International Financial Reporting Standards in India, it is important to understand these benefits. The first benefit is benefit to economy. The convergence benefit the economy as it would result in increased growth of its international business, orderly and efficient maintenance of capital markets, increase the capital formation and economic growth, attracts international investors to invest and increase the foreign capital flows. Benefits to investors. It would benefit the investors by providing investors the information that is more relevant, reliable, timely, and comparable. It is providing better understanding of investment opportunities. Further, it is reducing cost, time, and efforts to understand the financial statements. Further, it is making global comparisons easy. Now, benefit to industry. Now, what is the benefit of IFRS to industry? It would benefit the industry by making it able to raise capital from foreign markets at lower cost, creating confidence in minds of foreign investors, reducing the burden of financial reporting. Further, it is reducing the cost of preparing financial statements and compliance. The benefit to accounting professionals. It would benefit to accounting professionals by offering more opportunities in any part of the world, making able to advise and comply with regulatory bodies all over the world. Challenges which are to be faced for International Financial Reporting Standards implementation in India. It is very much important to have the knowledge of these challenges so that these can be removed for effective implementation of these standards in India. These challenges include problems which arise due to difference in generally accepted accounting principle and international financial reporting standards. The second challenge is to bring the awareness of international financial reporting standards. Lack of training facilities is another challenge. Legal and regulatory considerations, impact of taxation laws, measurement problems, changes in reporting and disclosure systems, and cost concerns are other problems which create obstacles in the way of effective implementation of IFRS in India. So these should be considered. Challenges to be faced for international financial reporting standards implementation in India. The first challenge is problem due to difference in GAAP and IFRS. There are wide and deep differences between Indian generally accepted accounting principles and international financial reporting standards. These differences may impact business decisions and performance. International financial reporting standards implementation in India requires change in financial statements reporting, and a new set of financial statements will be required to make changes. Challenge to bring awareness of international financial reporting standards. The lack of awareness of international financial reporting standard is also a big problem. IFRS implementation in India, and for implementation in India requires creating awareness among the users of financial statements about the international financial reporting standards and its impact. Lack of training facilities. For the IFRS implementation in India, there is an urgent need of providing education and training to stakeholders, employees, auditors, regulators, tax authorities, etc. The training should be provided about international financial reporting standards and its application. But in India, there is a lack of training and education facilities related with this. Legal and regulatory considerations. Currently, the reporting requirements are governed by various regulators in India, and their provisions override other laws. International financial reporting standards does not recognize such overriding laws. The regulatory and legal requirement in India will pose a great challenge in the way of IFRS implementation in India. Impact of taxation laws. International financial reporting standards implementation in India affect most of the items in the financial statements. This will have important impact on the calculation of tax liabilities. Thus, due to IFRS implementation in India, there is a need to make changes in taxation laws of the country according to new circumstances. Measurement problem. IFRS is based on fair value measurement, and it is valuing most of the items of financial statements on the basis of their fair value. The fair value measurement will bring drastic changes and subjectivity to financial statements. Further, fair value measurement is a time-consuming, laborious, and costly process. It can be done with the help of valuation experts. Changes in reporting and disclosure system is an important challenge which is faced while implementation of IFRS in India. Due to IFRS implementation in India, the companies have to amend their existing business reporting and disclosure systems. As the reporting and disclosure requirements under IFRS are different from the reporting requirement according to Indian principles. So changes have to be made in reporting and disclosure systems, which is a difficult task. Cost concern. Organizations dwell following cost concerns. For example, initially cost increase very much due to dual reporting requirement. Companies have to face dual reporting requirement according to their national accounting standards and according to international financial reporting standards. So initial cost increase. Further, cost have to be incurred for modifying traditional accounting system for meeting the international financial reporting disclosure and reporting requirements. Because international financial reporting standards are providing new requirements, and to meet those requirements we have to modify our traditional accounting systems, and organizations have to spend cost for that. So students, let us now summarize what we have learned in this module. Convergence of accounting standards aim at developing a globally accepted common language of accounting. The process of globalization and increased cross-border investing have generated the need for development and adoption of a single set of high-quality universal accounting standards. In India, the process of convergence with IFRS is carried by Ministry of Corporate Affairs. The Institute of Chartered Accountants of India has formulated Indian Accounting Standards, Indian AS, converged with IFRS, which are in the line with corresponding international accounting standards, international financial reporting standards adoptable under the conditions prevailing in India. The convergence of accounting standards provide benefits to economy, investors, industry, and the accounting professionals. The difference in generally accepted accounting principle and IFRS challenge to bring awareness, lack of training facilities, legal and regulatory considerations, impact of taxation laws, measurement problem, changes in reporting and disclosure system, and cost concerns are some of the problems which are posing challenges in the implementation of international financial reporting standards in India. Thank you.